If you've ever heard that a fund with a 28% dividend is not a trap, you've been misled. In fact, if you've ever heard that something with a 10% dividend is not a trap, you've been misled. This is Ethan. I'm a chartered financial analyst, investment professional, and bearer of bad news that can help save you from financial ruin. In today's video, I'm going to use RDTE, the Round Hill Small Cap Zero DTE Covered Call ETF, as an example to show you all the dirty little tricks that most high income ETFs play to lure you into their yield traps. Let's dive in. RDTE is part of a massive wave of new high income ETFs that take a volatile underlying asset and write covered calls on it to generate high income. That's things based on the NASDAQ or tech heavy indexes like JEPQ and FEPI, the S&P 500 like SPYI, small caps like RDTE, or individual stocks like the YieldMax ETFs. They're all different, but in a sense, they're all based on the same basic concept. Option premiums are based on volatility. So if you write covered calls on a highly volatile underlying asset, you'll receive a lot of option premiums, aka a lot of income. What they don't tell you is that this is not sustainable. But before I get to that, let me address a few things they say to trick you into thinking that this one is different, aka what they do to trap you. RDTE plays all the most common tricks, so that's why we're going to use that one as an example. First, they quote the distribution rate by only using the most recent income payment and assuming it stays the same for a full year, which of course it won't. So if you happen to catch one of these ETFs after a period of higher volatility, its income will look astronomically higher than it will actually be over a full year period. When I first started doing this video, it was at 28%. Now it's at 35%, like a week later. This figure tells you nothing, but those periods where it shows up extra high are the ones that lure people into the trap. What you want to look for as a better indicator is the 12-month distribution rate or 12-month yield, which you can find for any ETF with a one-year track record on Morningstar. Of course, our DTE doesn't have one because it hasn't been around for 12 months yet, so how convenient. Second, they use zero DTE options, which essentially are options that expire that day. So basically, our DTE sells call options in the morning that expires by the end of the day. Then overnight, there is no covered call. So you just have exposure to the market movements of the Russell 2000 small cap index. They do this for two reasons. First, so they can provide weekly income instead of monthly. Most covered call strategies sell monthly options and thus collect and then distribute income monthly. Doing this weekly makes the problem of misleading yields even worse. People also think that doing this weekly makes it compound faster, but that's wrong for two reasons. One, if you're taking out the income, it's not compounding at all, even if they pay you daily. Two, that's how compounding works in general, but it doesn't apply to ETFs or mutual funds. In the case of our DTE, it will generate covered call income daily. The income, like any other returns that the ETF generates, is immediately reflected in the NAV, the net asset value of the fund. So if it pays income every Friday and generates some income on a Monday, that income is already in the fund, reflected in its value, and it will be compounding at the same rate as the NAV Tuesday through Thursday. Then, when the ETF makes its distribution on Friday, the NAV falls by the exact amount of the dividend payment, plus or minus the ETF's actual return for the day. If you reinvest it, you just have more shares at a lower price, but the actual value of your investment hasn't changed. So maybe instead of 10 shares at $11 a share, you have 11 shares at $10 a share. Whether this happens daily, weekly, monthly, or at any other cadence, it doesn't matter to your total return. The second reason they use zero DTE options is to give investors uncapped return while the market is closed. Those options expire by the end of the day. So if there's a big rally overnight for some reason, they get the full benefit of it, whereas other covered call ETFs might have the upside capped. That's true, but it also works both ways. What if the market is down a lot overnight and then recovers in the day? Then they'd capture all the downside and cap the upside in their recovery. So I think all this really does is open the ETF up to additional risk and unpredictability. It might work out in your favor, but it also might not. The third common trick these ETFs use to lure you into their traps is by basing them on underlying investments that I would refer to as hot and spicy. Hot in the sense that they're something everybody wants to invest in, like they're hot right now, and spicy in the sense that they're volatile, which makes them pay much higher yields from covered calls. You can find tons of these on the NASDAQ, growth, or other US tech heavy investments, but I don't see any based on utilities or telecom companies. Why do you think that is? There are a ton based on the S&P 500 because everybody loves the S&P 500 and it's been doing great lately. How about on the MSCI EFA International Index? I haven't seen many of those. You can find them on hot and spicy companies like Nvidia and Tesla and Coinbase, but I haven't seen any on boring blue chips like McDonald's or Verizon yet. When these are based on something spicy, it juices up the yield and lures people in. When they're based on something hot, it makes people feel like they're getting the upside of that asset class, but they're not because the covered calls cap most of the upside potential and the ETFs pay out such unsustainable levels of yield that your investment is likely to dwindle down over time when you take out the income, even if what's been hot stays hot, which has literally never happened in the history of the stock market. That brings us to the fourth trick they use, which isn't really an intentional trick by the ETF companies, but it does trick investors because most of these simply don't have track records through any kind of real downturns. But the downturn and subsequent recovery is when they're most likely to really show their weaknesses. Let me show you. With dividends reinvested, our DTE has actually beaten IWM, the Russell 2000 ETF, since its inception about 4 months ago. But if you had been taking out the dividends, like most people do, our DTE would actually be down while IWM was up. This is only over a 4-month period with no real downturns, though. Here's one that's been around a little longer, TSLY, which is based on Tesla. You can see that even with dividends reinvested, it went down right in line with Tesla in 2022. So it didn't really protect you on the downside, even with the dividends reinvested. And then it really fell behind the actual Tesla stock in the recovery. Then, in the more gradual decline, it held up better than Tesla, but never caught up, and fell even further behind Tesla in the next recovery. Then it made up some ground during the next gradual decline and fell way, way behind in the last recovery. So, when did these ETFs do well? When the underlying asset is in a gradual decline. But are you investing in these hot areas because you think they'll be in a gradual decline? No, of course not. And when do they capture the full upside potential? Basically, never. Only if the underlying asset rose at a slow, steady pace without any major downturns or rallies would they be likely to do better than the underlying asset. And these are spicy assets, so that kind of sustained, boring return pattern is just not very likely to happen. All of this is still with dividends reinvested, by the way. Had you been taking them out, your TSLY shares would now be down over 63% in just over 2 years, while Tesla's stock was up over 133%. Yes, this is an extreme example of something very volatile with a very high yield, but this is how they all work. They just won't usually deteriorate as fast or trail by as much when they're based on a less spicy underlying asset. But make no mistake, this is likely to happen with all of them. Here's XYLD, which is based on the S&P 500, a less spicy asset. It's trailed the S&P by almost 150% over the past 10 years with dividends reinvested. Now, if you had taken your dividends out, you'd actually be down. Over the 10-year period, you'd be down. Now, some of you may say, well, I can take being down 4% over 10 years, so that's sustainable enough for me. And that would be true, but this is highly misleading. You see, XYLD did not always pay the 10+% yield that it pays now. It's changed its approach and objective not once, but twice. Some of you who know XYLD sells at the money calls now are probably thinking, well, yeah, of course it can't keep up on the upside. Fine, then let's focus on the period from December 15th, 2017 to August 20th, 2020, when it was tracking an index that sold 2% out of the money call options monthly, which is right in line with what most other covered call ETFs are doing. It trailed the S&P by almost 30% in less than 3 years with dividends reinvested. And mainly that happened in the recovery after the downturn. If you'd been taking out the dividends, which weren't even that high at the time, they were in the 5 to 7% range, you would have actually lost 13%, even while the S&P 500 made about 27%. These strategies are simply not equipped to handle downturns and recoveries, and thus are not sustainable over time. But When you look at one that hasn't been through a downturn, you can't see that. But now you've seen their true colors. So let's think about this logically. The long run stock market return is about 10%, right? Do small caps or tech or any of these other underlying assets offer anything significantly higher than that? No. Maybe slightly higher, but with more volatility and nothing like 28%. And were covered call strategies just invented? No, they've been around forever. And have they been able to enhance long term returns to 28%? No, they've actually proven to reduce long term returns compared to holding just the underlying asset. So then why would you ever think a 28% yield would be sustainable? Why would it not be a trap? Where is that money going to come from? If your investment is not earning 28% per year, how will you take out 28% per year without dwindling away your investment? The answer is you can't. That's why it's a trap. They lure you in with this ultra high yield and they present clever marketing slogans to make it seem like their version is somehow different or better. But in the end, it's simple. If the income stream is higher than its long run total return, it is mathematically impossible for the investment to be sustainable. Really, the threshold for how much income you can take while sustaining the value of your investment is actually lower than its long term total return because of the volatility, and the covered calls make this worse. We saw that in the XDTE example. I've explained this in greater detail in many other videos, but as a general rule, if it's based on anything related to the stock market and it yields 10% or higher, the odds of you being able to take out all of that income and maintain the value of your investment in the long run are essentially zero. I'm sorry to be the bearer of bad news, and trust me, I don't enjoy it. And this channel would honestly grow a lot faster if we just told people what they wanted to hear, but there are plenty of other channels that do that. This one is run by two experienced investment professionals, and we can't just sit back and watch people be misled into betting their retirement on a false promise that has almost no chance of working out. So, if you actually want to take your financial future seriously and become a better investor, hit that subscribe button. You won't always hear what you want to hear, but you will always hear what you need to hear. We don't have crystal balls, but we offer unbiased perspective on all things investing from two actual investment professionals that aren't trying to sell you anything. All we ask is that you hit that like button, hit that subscribe button, and leave a comment with what you'd like us to cover next. And if you want to connect with my partner Kyle and I directly, you can do so by clicking on the link in the description and joining our Discord. Thanks for watching, and we'll see you in the next one.